All right. Thanks, gentlemen, for joining. It's always good to see the four of you again, and looking forward to our discussion today about what's happening in our respective markets. And I think that where we talked, I think last fall, we started the conversation off with, what's happening with the pandemic and the COVID environment in each of our markets. I thought that would be a good place to start and the impact it's having. In the U.S., it's still here. Omicron is still here. Clearly, we are improving. The numbers are going in the right direction. But the good news is that it doesn't seem to be having the same impact as the previous strains from a virulence perspective, which is good. And then we just got the jobs report yesterday that you may have seen in the U.S., where we created 467,000 jobs, which far exceeded, the expectation. And for me, what that says is previously in this pandemic environment with the COVID, if we had the number of cases we're having, we'd have probably seen 1 million job losses, right? But I think that we're starting to learn to coexist with the virus, if you will, in the U.S. And I think you're starting to see some of our leaders, even whether it's the mayor of New York, saying we've got to learn to coexist with this. I think from where we were a year ago, when there were no vaccines, there were no treatments, I think people are saying, yes, it's less virulent, but it still has some severe effects on some folks. But at least we've got some treatments that we can use now. So maybe it's time to start getting back out there. So I think you're starting to see more companies ask their employees to come back to work, whether full-time on a hybrid method on a voluntary basis. In the U.S. at KPMG, we've reopened back up, but it's on a voluntary basis. If you feel comfortable, come in, and we're starting to see that pick up. But I think hopefully we're on the tail end of the pandemic, and we're into whatever they call the endemic part of the virus, and that we'll start seeing, normal. The good news is, as I told a board a few weeks ago, the pandemic, and asking, my views on coming out of the recession. In some ways, I ask in the U.S., did we actually have a recession? In some ways, it doesn't feel like that. And for a lot of my real estate clients, for example, if this is what a recession looks like, I think they take one of these about every 3 years, because pretty good for a lot of them from a business perspective. But I think it's really been a health crisis that's put a strain on, our labor market and a lot of people's mental health. But from an economic perspective, people come through it pretty well. So maybe Lino, from a Brazil perspective, where we at in terms of COVID and its impact on the market?
Yeah, so Greg, in Brazil, so the new variant is spreading fast. So we have a high number of cases, but just a few number of deaths. What's good. So we are seeing clients went back to home office again in order to avoid contamination. And we definitely see the hybrid model will succeed in the future. And offices are being reevaluated as well. And on the real estate market, houses has been, the houses market has been increased a lot because of that. People are looking to leave their apartments and live in a house. So that's what we are seeing here.
Terrific. Yeah, we've had something similar. The housing market is also extremely hot in the U.S., I think, for a lot of the same reasons. Carlos, Mexico, where are we at with the COVID in Mexico?
I think it's a very similar story. We had a huge increase in cases due to Omicron the first 2 weeks of the year. It started slowing down from the past week. And I'd say the economy was hit by COVID mainly in 2020 and early 2021. And I think the lack of governmental support made the government lift restrictions from the second half of 2021 on, regardless of the status of the pandemic, which, as you may know, took a big toll on Mexico. Mexico's economy is not growing at the same pace now as the rest of the region, but I wouldn't blame that on COVID. I think it has more to do with governmental policies or lack of than COVID. As it relates to the economic activities, they're all back to normal, I would say. So I think we're past COVID as it relates to activity, but we need to make some changes to keep the economy growing as we would like and as the rest of the region is doing now.
Terrific. And Tom and James, from a Canadian perspective, other than I know you're really nervous about your folks coming down to the U.S. and coming back, but other than that, where are we at? Or at least you're nervous about your truckers coming over the line and coming back, right? So other than that, what's it look like in Canada these days?
I think we'd like to send a few of those truckers down to the U.S. right now, but anyway, why don't I start and then I'll let Tom jump in. I think it's kind of in some ways a similar story to what you talked about in the U.S. and the other regions. Toronto and Montreal have actually just recently opened back up and reduced some of the restrictions that we were under because of Omicron, which is a good sign. And the expectation is that that's just going to continue. Quite frankly, in the West, they didn't put in that much in terms of additional restrictions because of Omicron. And honestly, when I talk to asset managers these days, I tell you they're probably worried more about the impact of inflation on their business than they are necessarily about kind of the continued impact of the pandemic. I mean, they do see some volatility coming from it, but I mean, that's not seen as kind of the most significant risk. And a lot of them now it's business as usual, although obviously still working from home quite a bit.
Yeah, look, maybe I'll just add to that from a real estate perspective. As James mentioned, some of the restrictions have now been relaxed in several of our jurisdictions, so that's welcome. I mean, clearly this has had an impact on real estate. It's had an impact on occupancy levels in office. It's had an impact on retail. But the sense in Q4 was that we're coming through that, and so there is some optimism with Omicron getting its way through the population as quickly as it is, that it will be back to what we were seeing in Q4, which is an upward trend in activity and occupancy. And people are actually quite bullish. I think one thing that we are noticing that maybe wasn't on the table pre-COVID is that some of our major owners of offices are looking at what to do with their portfolios and just asking the question, how long will this take to bounce back? Should there be something different brought to the table? Should we be, looking at some sort of repurposing, maybe changing our mix? And, that's not a conversation that was taking place to the same degree before. We did have a major transaction here in Toronto with the sale of Royal Bank Plaza. Oxford sold that to a Spanish individual. So, you already see, some things in the market that you wouldn't have seen before. And I think everyone's asking the question of where this will go, but it's a little bit too soon to tell right now.
Yeah, that makes sense. And, James brought up inflation. So maybe just one more round the table discussion before we get into some specifics about the country. The U.S. is the same way. We have 7% inflation today. And, there's a debate among the economists whether it's transitory, is it not transitory? Those debates go on and on. I think I've decided that it's basically transitory until it's not, right? So I'm not sure anybody knows. I think though what it is going to trigger in the U.S. is we will see some rate increases this year, probably 3 or 4 rate increases, at least in the short-term rates. I'm not sure that'll have as much significant impact on the long end as people may think, but it's probably a good thing that we start to move rates up in the long term. And so I think you will see that as a way to, fight off some of the inflation. And inflation for a lot of our parts of our business and asset management, specific real estate, it's not necessarily a bad thing for our industry overall, depending on how much challenges it produces for the economy overall. But from a real estate perspective, especially in some of the areas that can reset rents relatively quickly, not so bad. But I think that our chief economist in the U.S. believes that, inflation will stabilize, in or moderate in 2022, and then come back to more normal range in 2023 after the rate increases. But maybe, thinking about inflation, James, you brought it up. what's your thoughts on what inflation may do in Canada going forward, and then its impact on the industry?
I mean, we're definitely seeing a shift in terms of asset classes. Real estate is one that obviously can benefit. We're seeing a shift in terms of precious metals, certain other equities as well. I think the view is here we are going to see rate increases this year. I mean, the Fed here, didn't pull the trigger, but I think that was quite frankly a little bit surprising to other economists in the bank. So I think the expectation that's going to happen for sure in 2022. And I think there's a view that, inflation's here to stay a little bit, at least into the moderate term. There's still a lot of supply issues. And I think, from a food supply, energy, oil, heating oil, everything, like, it's having a big impact here. So I don't think it's I don't think it's going to be a short-term thing within Canada, and I think that's kind of the general view.
Yeah, I think the supply chain issues will moderate. I think they'll work themselves out. In the U.S., though, the thing I'm concerned about is we've had significant wage increases in the U.S. across all of our industries, and it's in my experience, it's really hard to take those wages away once you've given them, right? And so I think that continued inflation in wages is going to continue to put pressure on it. But I think the supply chain issues will work themselves out as we get further through getting more open. So
we've definitely seen that impact of the Great Resignation and what that's done on wages, no question, and kind of every industry. And financial services, asset management has definitely had a big impact in terms of wage increases.
Yeah. Carlos, what about Mexico? How's inflation impacting the market in Mexico?
Well, it's had a huge impact. 2021 was the highest we've had in the last 20 years. We ended up with 7.3% annual inflation, coming from 3.15 in the previous year and 2.80 in 2019. So that's caused interbank rates going up. We started the year, I'm talking about 2021, with roughly 4.4% the rates, and ended up the year in almost 6%, which was a huge increase. Our expectation is that it won't continue to go up in the way we saw last year, but it won't go back to the 3% or 2% levels we had in the past. So we're looking at 5% inflation for the following years. And with this rate increase we had in the last quarter of 2021, we wouldn't expect rates to continue going up. So we're expecting rates in the 6% more or less for the coming years.
So with those increased inflation, both in Canada and Mexico, in the U.S., I think we can sustain even the consumer some inflation in the short term. The balance sheets of the consumer in the U.S. are really strong. We had significant government stimulus last year. So even though no one likes prices to go up, but I think that if you look at the savings rates in the U.S. and the balance sheet of the consumers, they're pretty strong. So I think that the impact on the overall economy, if we can get the inflation rates to subside, over the next 18 to 24 months, we'll probably weather it pretty well. Is it the same in Canada and Mexico?
Yeah, look, maybe just to add to what James was saying, I think that's the case. If I looked at the impact of inflation, Greg, I don't think anyone is so to speak freaking out about it. I mean, certainly there's an expectation that increases in rent will result and will make up for any increases in cost. I think what people have their eye on is the rate increases that you spoke about and how quickly those rate increases are brought in, and whether or not the relative banks or the banks in the various countries, Canada, the U.S. and otherwise, are prudent about bringing in those rate increases and don't cause unnecessary recession. I think the only other item that I'll put on the table that's more a political one And Carlos mentioned it as well, but the rate, or maybe it was you, Lino, the rate of increase of housing prices is certainly of great concern to the broader population, and things like that can often lead politicians to react in different ways. So jury's out on that still, but certainly something to keep your eye on.
So Lino, inflation, maybe last question around inflation, and then what's inflation environment in Brazil and how's it impacting market?
Sure. So Brazil inflation is currently 5.29%, which is above the Brazil Central Bank forecast, which is 5%. So in order to contain the inflation, so in the forecast, the central bank has raised the interbank rates in Brazil from 2% to 10.75%. So they really expect with that increase, they will reduce consumption and then maintain the inflation on the forecast. So, but in the other hand, when we look to the funds industry, the AUM of the industry has not been impacted by that. So we still have 4.9 trillion Brazilian reais as AUM. And you know, one of the things that managers are considering because of this high increase of the interest rate, probably you're going to see the shift to some fixed income products instead of structured products like they were having before.
Terrific. It sounds like across the board, you know, maybe some concern about the inflation, concern about how prospective feds will react to how quickly the rise in interest rate, but nobody's panicking. Nobody's panic at this point, thinking we're not going to be able to weather, you know, the inflationary environment or the rise in interest rates. So maybe just now moving to, you know, specific markets. And James, I'll start with you. Just maybe your thoughts. We've kind of talked a little bit about COVID impact on the economy, inflation, but what do you see happening in the asset management market? You know, you've seen any significant changes? Are we still on track? Maybe just kind of your thoughts on the asset management market.
Yeah, I mean, it's been a very strong and resilient market kind of throughout COVID, as we've talked about before. You know, we are seeing some interesting product trends. You know, we're seeing a lot more in kind of the crypto world in the last few months, and beyond just kind of Bitcoin and Ether. You know, some broader index offerings, which is interesting, and you know, something that the regulators have, you know, had to get involved with. But there does seem to be some increased demand for those kinds of products. So I would say generally, you know, the capital markets have been quite strong throughout. I mean, we talked a little bit before about IPO activity. I mean, 2021 was a very, very strong IPO year, especially in the high tech space. A lot of unicorns, and you know, that certainly has helped kind of the asset management and the asset managers and the PE world. So you know, those trends, and you know, I think we're going to talk about a little bit later on, but ESG is of course still very much top of mind, and you know, from a regulator perspective, there's going to be a lot coming down the pipeline on the ESG front, and we could talk about a little bit further on. But generally, Canadian asset managers have carried through very well, you know, through the last 2 years.
So are you anticipating the robust IPO and M&A market that was in 21 to continue in 22?
That is the general expectation. Yeah. I mean, unless, you know, I think the only thing, you know, there has been some worries about labor shortages, which we've alluded to a little bit, and how that's going to impact companies being able to grow. You know, inflation concerns somewhat, and you know, rising interest rates, but generally, I think the expectation is the markets are going to continue to be strong right through 2022 into 2023.
Yeah, and I think I would say the same thing about the U.S. And my really only significant concern is labor. You know, we've talked about it, the labor shortage, because the only way you get GDP growth is you have more workers or you get more productive. And maybe we'll get some productivity gains out of this as people have invested more in technology, but otherwise, unless all of us want to work harder, which I think we work pretty hard, we've got to have workers. And in the U.S., we've had about 4 million workers that left the workforce pre-COVID that haven't returned. You know, a big chunk of those, by the way, were 55-year-old people who decided to just retire. And I thought many of those would come back. I'm not so sure now. I think they've got pretty comfortable, you know, in retirement. And so the concern is in the U.S., where are we going to get the workers? I think we won't go down this path, but I think we need to, you know, really do something on the immigration side to increase the amount of folks that are coming to the U.S. to generate workers. But it is a real concern as we think about growth. You know, where are we going to get those workers?
And,
So
and
Tom,
not just, sorry, I
yeah,
was just going to say, not just as a follow-on, not just older workers leaving the workforce, but younger workers deciding to go part-time into
oh, yeah.
part-time work, which was definitely a trend we did not see significantly before COVID. I mean, that, you know, I think has had almost a significant impact, especially in the major centers here.
Yeah, or leave, and you mentioned crypto, or you know, leave and I'm going to go start a crypto fund, right? So I can go stay on mom and dad's couch and start me a crypto fund, and you know, so I think it'll take a while for that to work out, but there is a concern, you know, where are the workers coming, and not just in, you know, our business, professional services, but in the construction area, in the hospitality area, there is a shortage. Almost everywhere you go, they need workers. Estate perspective in Canada, maybe it's where that stands. And, you know, James mentioned crypto or digital. I continue to get requests for interviews on the metaverse, like that's real estate. I'm going to say, what's the state of the real estate market in Canada? Are you seeing some uptick in the IPO market, M&A activity continue to be strong?
Look, I would certainly say it's a very bullish market. There's no surprise and no secret that there's a lot of money looking for a home. You know, it's a great hedge against inflation, and real estate has certainly benefited from some of that capital that's floating around. The pricing has continued to increase as a result. Again, I think it's pretty common knowledge in North America what's happening with the multifamily and industrial pricing. That's just red hot, and you know, even some of our most sophisticated clients are struggling at winning deals just because the competition is just so strong. We are seeing development pipelines come back. There was some pause in the market because of COVID and some of these supply chain issues, but they seem to be getting fired back up. And you know, just a steady stream, Greg, of new deals, a lot of new joint ventures, small funds being created. We get calls almost on a daily basis for new ventures that people are interested in funding or creating in some way. IPO activity, I would say it was very muted for the last number of years. That the private markets are just so hot. It's just hard in some ways to justify the pricing of an IPO versus what you can get in the private market. But that being said, we have seen some activity. I would expect that there are some IPOs in the real estate space coming to the market this year, more from, you know, well-capitalized sponsors rather than, you know, maybe some of the traditional you know, private companies going public, but it's still a good sign to see that's taking place.
From a cap rate perspective, looking forward to 22 and 23, I mean, in the U.S., I mean, across all, you know, the segments, I would say we're steady cap rates. I actually think there could, believe it or not, in those two spaces you mentioned, multifamily and industrial, could still see some compression in those cap rates because of the demand for the product. I mean, in the U.S., I think you're going to take 5 years to even develop enough of supply in industrial space to meet the demand. You know, we're still not there yet. So from a cap rate, you know, pricing in Canada, you still thinking this year is going to be steady as she goes?
I do think it'll be steady as she goes, just because of the amount of capital looking for investment opportunities. And you know, in your market in particular, we've been seeing rents, for example, for multifamily of you know, rents increasing by as high as 20 to 30% in the last 6 months. I mean, just the statistics are just very, very impressive. We don't see that sort of thing in Canada, but certainly I do expect the cap rates to remain stable, if not come down a bit.
And from maybe just one other question about the real estate, from a technology perspective, real estate generally has been generally has been a laggard to other industries in the adoption of technologies to drive efficiencies, to drive, a number of different productivities. Are you seeing a increased interest in your real estate clients around technology and how it could, enhance their business?
That's actually been a bit of a surprise. It's just the amount of capital that's being put into technology by real estate companies. To your point, if you go back 5 or 6 years, we would have, struggled to see, investment. We would have struggled to see, the business case being made for increased investment in technology. But now you have, whether it's ESG or whether it's just trying to get operational efficiencies, or to a great extent, we see a lot of real estate companies trying to get operational efficiencies through finance function transformation and the use of data. So I would say generally at a high level, a huge amount of interest in technology in various areas, including, prop tech, which everyone has heard about. And just an impressive interest in trying to do things in a better way and make use of technology and data to get there.
Yeah, very consistent what I'm seeing as well. So Carlos, let's move to Mexico. I know there's been some recent changes in the asset management industry, and I think even some changes around, capping fees that, pension fund advisors can make, which is an interesting concept to someone in the U.S., capping fees. But tell us what's happening, in regards to that, and maybe broadly, what does the asset management market look like in Mexico today?
Okay, Greg. Well, it's interesting for Mexico too. It's it's a new thing to us, and talking about the asset management industry in general, and I'll go back to the pension fund fees in a little while. As Tom said, the IPO activity in Mexico has been muted, but we've been on mute for a while now. The Mexican IPO market has a lot of potential, which, even though a new stock market was introduced a few years ago with a clear purpose of speeding up the IPO market, that hasn't happened. A lot of private activity is still ongoing, and somehow but companies not wanting to go public, or and that's something that we've seen in the past, and I don't think we'll see a change in the short term. Talking about the pension fund industry capping fees that you mentioned, it's what's been on the spotlight lately, and it's a quite significant change. It represents almost 30 basis points, going from 0.8% to nearly 0.55%. That translates into, I would say, $600 million in savings for the workers, which is $600 million less revenue for the pension fund managers. While it represents a short-term impact to the system, it's planned that it will be gradually offset by an increase in AUMs, because this law, while it caps fees, it also increases the rates at which the employees will contribute to the pension fund. So it'll be a short-term impact, but in the mid and long term, it'll be offset by way more AUMs. The rate, the contribution that employee makes now, it's 6.5%, and it'll go all the way up to 15%. And that's when you'll see a huge increase in AUMs. But in the short term, we're looking at a lot of companies not being able to make it, given this fee cap. A lot of smaller players will have financial trouble, I think, and that'll end up translating into a lot of M&A activity in the pension fund business.
So was the driver behind that is that the government didn't feel there was enough competition in that space, and so the market wasn't driving the fees down? Because seems, if you think about it, one is if there's not competition, maybe that's a reason, because two is by capping fees, you could take, quality advisors out of the market, right? Just to say, if I can't make money doing this, and I'm going to get out of the business, which has the other impact on the pension funds themselves. If I don't have good advice, that's going to impact my returns. Just curious, without, going into all the intricacies of the government, but what was the driver behind, well, we're going to cap these fees?
I don't think it was competition, Greg. I think it was sending a political message rather than competition. And now the challenge for every pension fund manager will be offering better returns. No longer it is a fee thing because all are capped at the same level. So, but it was way more political than having to do with the system itself, I think.
Okay. Yeah, we have some of those decisions in the U.S. as well. So Lino, Brazil, the IPO market has been heating up. I read. So why don't you give us some thoughts on what's happening in Brazil and the asset management market? Is it true what I read? The IPO market's still very hot, and what do you see going forward?
Yeah, sure. So the M&A transactions, they are hot in the market. So fiscal year 2021, Brazil Stock Exchange had 45 IPOs and 26 follow-ons, with a total fund raised of 129 billion Brazilian reais. So, and for 2022, it is expected a reduction on the number of M&A transactions, but that is due to the presidential elections, which will happen in October and November. Investors expect, because of that, more volatility in the market, and they will prefer to be more liquid than invested in order to react to the opportunities that the market will arise, right? So in the funds industry, it is expected that CVM, our Brazilian SEC, will release the new funds regulation until the end of the first semester of 2022. The new regulation will cover all the changes brought by the Economic Freedom Law that was passed in Congress in 2019. And basically, the changes that are very welcome will bring Brazil funds industry to the more close to the international market. So just to have an idea, so the major changes are limit liability of the administrators and service providers, possibility of funds have different classes, like umbrella funds, which today is not allowed here. Internationalization, so allow retail investors to invest up to 100% of their portfolios in BDRs and ETFs. So today we have that only for professional investors, which are investors with more than 10 million. But this is something important in the market. So the redefinition of leverage limits for each type of fund and investors as well. Creation of side box and gates to segregate liquid and illiquid assets from the funds industry. Open credit funds to retail investors as well, and create a new category of fund called ESG credit funds. So these are, the major changes that the marketing is expecting that will be released, and that will be very good to the funds industry in Brazil.
Yeah, sounds like all of those things would be, very attractive to capital, right? I mean, everything. I was listening to things you ticked off. I said, well, that's going to attract capital. That should attract capital. Should be a positive, for the industry moving forward. Interested in the ESG credit funds. Maybe expand on that. We kind of mentioned ESG, and maybe we can go around the horn here and talk about what in the regulatory environment, what's happened with ESG in your countries, and then more importantly, are you seeing clients start to react to investors that may be asking about, and what are your investors asking about ESG? So the ESG credit funds in Brazil, maybe expand on that a little bit. What
Sure.
are they, and give us a little more insight.
Yeah, sure. So until today, so we don't have any specific category of fund. So the idea of the Brazilian regulation is to create a fund that must invest in credits that will be sustainable, okay, that will happening the environment and the social and the governance of the companies. So and it's important to say that ESG, it's a topic that it's present in all managers in boards agenda in Brazil. However, the consistency on the ESG measure is still a challenge, so that would be very good for the market to have this type of funds. But and on the public hearing, we are seeing some suggestions to the Brazilian SEC to give more information on how you're going to measure the ESG of the assets invested by the funds. I think that it's an important topic.
Yeah, absolutely. I think consistency around that, even around the globe, is a challenge for all of our clients. So, hey, Carlos, maybe from Mexico, from an ESG perspective, anything on the regulatory front, or if not on the regulatory front, from a industry perspective, what's the discussion around ESG in Mexico? I think you're on mute, Carlos.
Sorry about that. I would summarize ESG in saying it's finally on the company's radar, but from a regulatory standpoint, as well as the companies acting proactively on it, we're not there yet. We're a little behind the rest of the world, but it's on the board's radar, which is a good thing. They know ESG exists. They're not sure how to move on with it. And as it relates to the regulation, we don't have that much of a regulation as it relates to ESG now. But companies are starting to react. It's on the radar, and a good thing is that as it relates to asset management as well as the financial industry as a whole, there's a lot of foreign-owned entities, and that's good for ESG purposes because we're getting whatever is happening at the headquarter level here in Mexico. That otherwise we wouldn't be that on board as it relates to the process. So not much to talk about ESG at the moment, Greg. It's something that already got here, but companies are starting to somehow digest, if you will, and seeing how it'll be moved forward. And the regulator is a little behind on that.
Yeah. So the companies, as they're thinking about it, are they doing that because they're seeing what the future may be, or are they getting pressure from investors?
It'll be both. It'll be, we need to go that way because there's no other way. But also, if we didn't go that way, we would get this pressure from investors that are starting to see the benefits of it. So it's both.
Terrific.
And a third one, which would be the parent company.
Right. Foreign owners and.
Yeah. Exactly.
Terrific. Well, in Canada, maybe James, start with you on the overall and the ESG, and then, as always, we'll figure out how the real estate folks are reacting to that because it's sometimes a different reaction. So, James, from a Canadian perspective, from ESG front.
Yeah, I mean, it's pretty much, it's a trifecta here. Like, it's the number one topic on the board level. It's the number one topic for institutional investors, including our large pension plans, and it's probably the number one regulatory priority right now. So you get all of that coming at companies and fund managers. From a regulatory perspective, we are going to get new required disclosures and public company financial statements and MD&A, and some of those disclosures will probably have to be audited. Now, I think at this point, most of those disclosures are going to be more qualitative in nature in terms of, strategy, frameworks, how they're managing risks, maybe control environment type disclosures. So that's probably what we're going to see at the public company level. But then the fund side, there's going to be additional disclosure, especially for those that identify themselves as an ESG type fund in a prospectus, lots more disclosures, some in the financials, some in our equivalent of, fund MD&A. So there's a lot coming down the pipeline. I mean, we would agree that, what's going to be measured quantitatively is still, a bit of who knows. I mean, we're looking to what's happening in the U.S. Obviously, we saw what's happening in California this week, and we're looking to Europe. But I think, at least from a regulator perspective, I think the Canadian regulators kind of feel like they want to be on the forefront of getting kind of their thoughts out there, and that seems to be happening. Lots has happened in the last 2 months.
So on the regulatory front, they're not necessarily looking to follow what Europe has done, but really trying to decide what they think is the right regulatory environment. Is that?
And in some cases, to be leaders, yes, which is obviously going to be challenging, especially for for asset managers, but for other financial institutions who have to figure out, how do they measure it in terms of their clients when they have many different relationships with clients, whether as equity investors or lenders and so on. It's there's going to be a lot of work to do, and in some cases, like some of these disclosures may come in within 2 years, and so it's not a lot of time for kind of the more complicated organizations.
Right, and it's a complicated issue, and even I was talking to one of my real estate clients this week, and he's a office landlord, and he said, so I'm going to be held accountable for my tenant's carbon footprint. I mean, I really don't have any ability to control what my tenant necessarily does, or maybe he does, but I think there's a lot of confusion about, as we go forward, who, what are we going to measure, who is responsible. So I'm a little concerned that because of the pressure to move forward, like a lot of things, we're going to move too fast, and we'll come back and say, okay, what does that mean? How do we deal with that? So Tom, from a real estate perspective, what are your clients and the market saying about ESG and the future?
Greg, ESG has been on the table for a while, right? So the good news is it's not new to anyone in the real estate industry, and certainly, the easier low-hanging fruit was on the social and governance side, and that's been a focus for a while. And I think a lot of real estate companies have made significant progress in dealing with that. But to James' point, over the last year, the importance of ESG has just risen right to the top of the agenda, and in particular, the environmental side of ESG. Everyone sees what's coming down the pike. You see this need for eventually reaching zero carbon emission. There are some benefits to implementing some of the technologies that would get you there anyway to reduce some operating costs. But ultimately, we're seeing an increased importance as a result. And one of the questions that you asked Carlos is, where's that pressure coming from? Clearly, there's also a lot of pressure coming from institutional investors and pension funds. I mean, they have, certainly sent the message to their managers that this is something that you need to take seriously and do. What are our clients talking to us about? I mean, they're talking to us about developing ESG strategies and roadmaps. They want to know how to get from where they are today to where they need to be. There's certainly a keen interest on staying ahead of the regulator and taking a leadership role, as some of you have mentioned today, to make sure that the industry is leading the charge and isn't necessarily becoming victim to what maybe a regulator would like. And part of that as well at a board level, Greg, is embedding the whole ESG strategy into their enterprise risk management processes and making it part of how they do everything they do. And That dovetails as well with what James was talking about on the reporting side. There's a lot of heavy lifting to be done. We've got the new standards from the International Sustainability Standards Board that have come out. So we're starting to see where this is going, and it's clear that there's a lot that has to be done in order for real estate companies to be able to understand and effectively report and interpret. To your point, Greg, right? Are you talking scope 1, scope 2? If you're not comparing apples to apples, what does that even mean? So a lot of interest, early days still, but it's moving quickly. And I would say real estate companies that we talk to are definitely taking it seriously and attacking it aggressively.
Yeah, I think it's very consistent. I think from a regulatory environment, we're probably a little slower than where Canada is. I think trying to figure out, what does the regulatory environment need to look like? And then I think that, from an investor perspective, we are seeing the same. The investors are pushing our advisors and our fund to, hey, you need to be taking ESG serious. We need to make it on the board agenda. The challenge is I haven't seen any of those institutional investors willing to lower their investment yield requirements. And, a lot of these retrofitting of buildings, it takes capital, right? And so to me, there's got to be a reconciliation eventually between, okay, investors, you want me to really focus on these ESG initiatives, but you still want to hold me to, these yields. And maybe we'll get to the point to where the yields are equal. But today we all know that they're not, right? And so I think there's still is going to have to be some reconciliation from that perspective. And then around even the transition, we think about the environmental side and the move away from fossil fuels. I think everybody agrees we need to do that for the climate. But the reality is, how quickly can you do that? And do you have, it's not like we could just shut it down and say, okay, we're not going to have them anymore. There's a process, and what does that look like from a scientific advancement from those things to get there? So how, as a fund manager, as a real estate owner, am I going to reconcile that with my investors? And then, as Tom said, the reporting is just, it's so inconsistent even with what people are reporting today. And so can you even compare? I was talking to a pension fund in the U.S. not too long ago, and he's getting reports from multiple funds, and he's saying, I don't know how to read these, right? So is it really even worth that much to them, because they're not able to even compare because it's not consistent? And so who's going to be the governing body that says, hey, here's what we're going to use? That's where I'm waiting to see who's the regulatory body that's going to say, here's the criteria, here's how you're going to measure, and that way you are able to compare and contrast, organizations, their performance, which is what, investors want, right? And I'm not sure, unless you guys know where that's coming, I'm not sure where that's going to come from. I don't. So I don't, Tom, if you.
Well, yeah, look, I would keep your eye out for the ISSB. I mean, that's part of what their mandate is, and they certainly have tried to, not start from scratch. They're looking at some of these reporting frameworks that are in existence today, and they brought some of those organizations on board to leverage off of what they've already done. So it's a huge issue that you're describing, and it's very much top of mind. But I have high hopes. Hope I'm not disappointed, but either way, I think it's going to take some time to get there.
Well, we're coming up at the end of the time. Hey, we've talked, it's been a pretty, rosy outlook. I think if you look, everybody's been very optimistic and positive, next year and the future of our industry. Maybe we can just, if you had to pick one thing, you said, okay, if I got to pick one thing that could, change that rosy outlook that might happen, coming in the next year, what might that be? Last year in the U.S., we had a lot of legislation on the table and tax legislation on the table that I would have said last year, there's some things in that could really change the dynamics. None of that got passed. And we are in an election year in the U.S. this year, which typically there is no significant legislation passed in election year. So now anything can happen. But so, and then if we got the midterms coming up, which means we could have a change in one or more of the houses, and there's some thought that the Republicans might take the House. And if they do, then we'll have a split government again, which means in the U.S., you're basically going to be status quo because we are not working together at all right now across parties. So if we're divided, we're probably not getting anything done. So I think from my perspective, outside of some geopolitical shot, we have an invasion of Russia into Ukraine or some geopolitical shock out there that changes the world. For me, in the U.S., it's I'll go back. I said earlier, I probably should have said is labor force participation. I'm really concerned as we continue to grow. We've got strong GDP, we've got strong growth across all segments of our industry. Are we going to be able to attract across all of our industries enough labor to drive that growth? I am really concerned. I don't see it right now to where it's going to be enough. Now I'm hoping that immigration opens up. I'm hoping that whether it's young people who decide they want to come back to full time, or they're tired of sleeping on mom and dad's couch and not doing anything, or mom and dad kicks them off the couch, whether it's some of those retired workers or some of those, as we open back up, we've got families that somebody had to stay home with the kids because there wasn't effective child care. Will they come back? But that's my biggest concern, as far as could dampen, our growth initiatives in the U.S. But Lena, what about you? What worries you in Brazil? If you had to pick one thing coming up that could change the rosy outlook we've painted.
Yeah, sure. So here in Brazil, so there are three important reforms that the market is expecting: the administrative reform, the fiscal reform, and the labor reform. And this year we have presidential elections as well. So, and in the year that you have presidential elections, you definitely will not gonna get that. So market will wait to see who will be the next president, and hopefully next year we're gonna make progress on those. I think that it's the most important here.
Terrific. So political elections, I think that's almost everywhere. So Carlos, in Mexico, what's the one thing that you worry about?
I always try not to get political, but it all goes down to government now, as I see it in Mexico. I think one thing that would compromise this positive outlook would be government not continuing to inhibit investments. This is a time where private sector has been excluded from everything, and that translates into growth. And without growth, there's no employment, or unemployment rates will start to increase. There's no GDP growth. You know what happens. So that would be if we continue to see this trend where the private sector is not considered for anything, investments are inhibited by government policies, that would certainly compromise a good outlook for Mexico.
Yeah, good points. So James, what about from your perspective? We'll go to Tom for last word on what's the one thing you're concerned about.
Well, you took labor shortage, so I don't want to duplicate. I think we talked about it earlier. I mean, the housing market is so important in Canada. If the Fed increased interest rates too quickly and we ended up with a housing shock, I mean, that could have a significant impact, no question. I don't really see it, and I quite frankly, I don't think there is anything that can impact the Canadian economy and significantly in 2022 from a negative sense. But they've been predicting a housing shock for about 30 years now, so at some point they'll get it right, and that would definitely have an impact, no question.
Fantastic. Tom, I'll give you the last word. What concerns you and your clients looking forward?
I think the one thing you hear over and over again is increasing of interest rates too quickly, and the shock that could have on the economy. So that's certainly one of the things that resonates among a lot of the clients that I talk to. I would say from my own perspective, Greg, it's the one thing that we're not thinking about that worries me, right? I don't think we saw Omicron, or forget Omicron, COVID coming. I don't think,
No.
we all knew the stuff was out there, but like that came out of nowhere. And so
Right.
I'm more concerned about something coming out of nowhere that no one's thinking about and knocking us off our game. But other than the interest rate observation, I think to James's point, things are looking pretty good so far.
Yeah, who would have thought 2 years from this COVID thing, I'm still sitting in my office at my home, right? I mean, I'd have lost my entire, my entire war chest that I have because of betting on that. I mean, just amazing. I was speaking on a webcast last November, and I said, I think, by second quarter, maybe we'll be back to somewhat normal. And someone typed in the chat and said, I think I listened to you last November and you said the same thing. So
We'll be right eventually.
right. Eventually I'll get there. So
You said
anyway,
what, but not from what year. So
that's right. I should have clarified that. Well, anyway, I know we're out of time, but let me thank each of you for your thoughts. It's always great for me to hear from each of you what's happening in each of the markets, and I know that our clients in the market will really appreciate hearing from you as well. So hope each of you stay safe and look forward to talking to you again soon.